Yes, hello everyone, Empire Crypto TV. Be sure to subscribe to our channel, like the show. We have many more videos on trading tutorials, especially for beginners. Today, we're talking about the Elliott wave theory. Of course, here on my screen is just an exemplary illustration of how I would draw out an Elliott wave theory, of course using trend lines, as you can see, just to smooth out the price action of the candlesticks so that I make it easier for you to see the pattern or the repetitive patterns, not only just the Elliott wave theory, other patterns as well, harmonic patterns, many other patterns that may need to be smoothed out to use out your trend lines. But for today, we're going to focus on the Elliott wave theory. I'm going to just jump into it. Elliott wave theory, actually, it's a man behind this theory, a legendary trader. Back in the old school days, during the 1920s, 30s, there was this mad genius named Ralph Nelson Elliott. Elliott discovered that stock markets thought to have behaved in somehow chaotic manner. Okay, they traded in repetitive cycles, okay, which is somehow true, which he pointed out were the emotions of investors and traders caused by outside influences like your news traders, fundamental analysis, CNBC, 24 news hour broadcasting and so forth, or the predominant psychology of the masses at the time. Okay, then it goes on to say, Elliot explained that the upward and downward swing of the mass psychology always showed up in the same repetitive patterns. Hence we see, which were then divided into patterns he called waves. These are the waves that he speaks of. So it's divided into two. There's an upward wave, okay, it explains here. Mr. Elliott showed that a trending market moves in what he called 3 or 5 wave pattern. The first 5 wave pattern is called the impulse, the one that you see on the screen on your right hand side. The last 3 wave pattern is called corrective waves. Okay, I think I have a complete example. They don't show the complete example there. You have the complete impulse wave all the way until stage 5. And then from the stage 5, then you have corrective waves. These are the 3 last corrective waves that the theory speaks of, which is the last one, corrective waves. You just don't see it here. And here I have just a real-time example, okay, on the chart that I picked up when I was opening the show. Okay, I might have extended it just a little bit, but this is how you would do it using trend lines. It doesn't have to be an accurate, perfect Elliott wave theory that you see on the theories, on the books, on PDFs. You should also use your own imagination and experience as well to try and smooth out the market. And here you can use an additional object or a measurement that is called the Fibonacci. So with these retracements are also measured with Fibonacci retracements. It's not just waves, but here fundamentally we are talking about fundamental analysis. What causes the waves fundamentally? The news trading, and eventually technically influenced in that manner. Okay, so there are stories that come from the broadcasters that they take out from time to time that affect the market to shape up in this manner. Let us read about it right here. Okay, so here is a short description of what happens during each wave. I am going to use stocks for many examples. You can use Elliott wave theory, stocks, crypto, and the Forex market. Quite relevant throughout all the markets. As I always explain, most of the lectures that we take out here are relevant for all the markets that you may trade: stocks, crypto, you may trade even Forex. Quite relevant. Elliott used, but it really doesn't matter what it is. It can easily be currencies, bonds, gold, oil, or tickle me, okay? The important thing is the Elliott wave theory can also be applied to the foreign exchange market, which Forex in short, as I was just explaining to you. So now this is what happens during these waves. This is the storyline behind the waves fundamentally, okay? The stocks makes its initial move upwards. This is usually caused by, this is the first move, okay? First, let me explain the waves. This is the first wave. Second wave, retrace. Third wave, usually the longest, and then the fourth one, retrace, and then the fifth wave, and then followed by the corrective wave, which is ABC, going down, D. Usually caused by a relatively small number of people that all of a sudden, for a variety of reasons, real or imagined, there's also some form of psychology when it comes to trading, feel that the price of the stock is cheap, so it's a perfect time to buy. This causes the price to move up right here. Buyers come in, all sorts of buyers. I imagine most of the time are bankers, big companies like banks, hedge funds. Alright, the second wave, which is this wave, just a short regression, okay? At this point, enough people who were in the original wave consider the stock overvalued and take profit. This happens right here. Just the take profit part, it does cause the market to just regress just a little bit. This causes the stock to go down. However, the stock will not make it to its previous lows before the stock is considered a bargain again. No, it won't make it to this level. So you just have this line here as your support. You draw a line as a support. If we look at our chart right here, you would have your line right here as your support level here, so that you can be able to anticipate a further going on right here on my stage, on the third stage right here. Okay. This causes the stock to go down. However, the stock will not make it to its previous lows before the stock is considered a bargain. Now the third wave right here, which is the longest wave. Okay, this is usually the longest and the strongest wave. The stock has caught the attention of the mass public. More people find out about the stock and want to buy it. This causes the stock's price to go higher and higher. This wave usually exceeds the high created at the end of wave one. So more people come in, gather more and say, hey, something is happening at the stock with the particular market. They get their attention. It makes the longest stock. Once again, we reverse, go to the fourth one. The people take profit once again like they did with the second wave. Because the stock is considered expensive again, this wave tends to be weak because there are usually more people that are still bullish on the stock and are waiting to buy on the dips. They want to buy right here on this dip, just a bit cheaper than here. Okay, so when you buy it here, it's much more cheaper than here, than to enter here, because it will dip, probably hit your stop loss. But rather here, where it can bounce back, I can show you on the chart also, on these levels, start buying right here so that you can anticipate growth beyond this previous high. And then the fourth, people take profit because the stock is considered expensive. This wave tends to be weak because there are usually more people that are still bullish in stocks, are waiting to buy on the dips. All right, wave 5, which is the final wave. This is the point that most people get on the stock and is most driven by hysteria. You know, everybody will be talking about it and, you know, going on about it. Wow, this stock, this tech, especially in the case of Bitcoin, hysteria can drive the market, whether down or up. Hysteria of negativity, hysteria of positivity in this case. But be assured that the Elliott wave theory applies not only in the uptrend but also in the downtrend. There is negative hysteria in the case of cryptocurrencies, the hysteria that FTX has gone down or gone bankrupt, that hysteria, that psychology has affected a lot of people, causing the market to go down. This is the final stage, but that is for the bearish trend, but also applies for the bullish trend. But this one is for positive hysteria as implicated. This is the point the most people get on the stock and is most driven by hysteria. You usually start seeing the CEO of the company like Elon Musk, Tesla, when he said he's accepting Bitcoins for his Teslas. You just saw the surge in the market afterwards. On the front page of major magazines as the person of the year, people start coming up with the ridiculous reasons to buy the stock and try to choke you when you disagree with them. Well, depends. This is when the stock becomes the most overpriced. Contrarians start shorting the stock, which starts with the ABC pattern right here. After that strong Elliott wave theory, when the stock has just pushed up, then you're going to start seeing this stage right here forming when they feel that the stock is overvalued. Okay, this is the theory of Elliott. This is how he saw it. And he says that these patterns are repetitive throughout time in trading in stocks, crypto, or the Forex market. Empire Crypto TV, thank you very much for joining us. Please be sure to subscribe to our show and support our show. Thank you. Until next time.